Is Mr. Market getting a little too bubbly? You're about to find out. Hi, I'm Todd, and this is the On Wealth and Progress podcast. If you're interested in balanced, factually supported commentary for a better future, you've come to the right place. This week, the government announced that July's inflation reading, as measured by the Consumer Price Index, was up 2.7% from a year earlier, which was consistent with the increase reported last month and well above the Fed's stated target of 2% inflation. The Fed also likes to look at what it calls the core inflation rate, which excludes more volatile food and energy costs, as a way to monitor underlying rates of inflation. For July, core inflation was up 3.1%, also well above the Fed's target. Remarkably, the stock market rallied on the news. On the day of the announcement, the Wall Street Journal observed, for the Fed, the lack of a more alarming acceleration in price pressures likely removes an obstacle to lower rates in response to growing worries about a slowing labor market. End of quote. Now, given that key measures of inflation are still well above the target, the celebratory expectation that the inflation report somehow justifies a rate cut is a bit like declaring victory in the middle of the third quarter, when you're still losing the game. Even as the markets eagerly contemplated the idea that the Fed might further juice things up, the stock price of yet another company skyrocketed on its first day of trading. The appropriately named Bullish, a cryptocurrency company, sold stock at $37 a share in its initial public offering, and the stock then soared to over $95 in its first day of trading. I mean, dude, don't bother me with some boring yada yada yawn about compound interest when I can double in a day, right? All of which may be why, even as Wall Street was chumming up the idea of the Fed turbocharging an already buoyant market, an episode of the Wall Street Journal's Take on the Week podcast asked the question, is the stock market in a speculative bubble? All of which brings us to a funny little fellow named Mr. Market. Let's take a brief break and then we'll be right back to discuss what the greatest teacher taught his greatest student about markets and investing. If you asked who is the father of value investing, many would answer Warren Buffett. And deservedly so. But if you asked Warren Buffett himself, he'd almost certainly give that honor to his first and perhaps most important mentor, Benjamin Graham. As a young man, Mr. Buffett's future aspirations took a bit of a gut punch when a rejection letter dashed his dream of going to the Harvard Business School. Nevertheless, in a twist of fate worthy of even the best Horatio Alger success story, Harvard's rejection left a resolute Mr. Buffett packing his bags for Columbia's graduate school, where he had the great good fortune to study under Benjamin Graham, the co-author of the book Security Analysis, which was first published in 1934, just after one of the greatest stock market bubbles in history. Because the captivating rise in the late 1920s had lured so many first-time investors into the market, only to then so dramatically dash their hopes and expectations, most people at the time came to view the stock market as a dangerously rigged, casino-like game for gamblers, speculators, and other unsavory creatures you might find in a Star Wars bar, but definitely wouldn't take home to meet your mother. In this environment, Ben Graham set about the task of showing how, while the stock market at times offers the opportunity to speculate on what, for a brief shining moment, seems like sure things, there's also another way to approach matters. Most importantly, Graham taught his readers and young students the difference between price and value, where price is simply the market price that a security trades at on a given day. But value is what a knowledgeable investor would pay to buy and hold an entire business over longer periods of time. Now, to put these ideas in modern lingo, a day trader is most interested in price, i.e., is this new IPO going to pop like what happened with the Bullish offering mentioned earlier? Or is this meme stock ready for a run if someone drums up enough speculative excitement on social media? In other words, traders are almost completely focused on the price, with the additional twist that a rapidly rising price is seen as a good thing, not a potential sign of danger. By contrast, an investor trained in the Graham tradition begins by poring through the financial statements of a company and works to understand the nature of its business so they can determine how much cash flow the business is likely to generate over time. The investor then estimates what Graham called the intrinsic value of the company from these cash flow predictions and divides the estimate of long-term value by the number of shares outstanding to estimate what each share of stock is actually worth, which is often very different from what that share is trading for in the market. And just to be safe, Graham also recommended then adding a margin of safety to this price, or intrinsic value estimate, which is an additional discount to intrinsic value to account for uncertainties. Just think of how much the prospects for Tesla's electric car sales have changed in the last year. So, Ben Graham was something of a financial scientist who taught his students to make investment decisions not on speculative whims, but rather on detailed and rationally based analyses of intrinsic or long-term value. Graham was also what we might call an objective realist, who knew that even the most careful estimates of value would inevitably be proven wrong by the inherent unpredictability of business, and so he added the margin of safety to protect against these risks. Now, in addition, Graham also had a brilliant grasp of the enormously psychological nature of investing, which can make it difficult for even the most normally rational individuals to avoid the alternating passions of greed and fear that market swings elicit. To help his students learn to think more intelligently, Graham created a character that he called Mr. Market. He told his students to think of Mr. Market as a highly emotional little fellow prone to extremes. Some days Mr. Market is filled with a buoyant sense of unimpeachable optimism. But on other days he suffers from equally rampant and unrelenting pessimism. Unfortunately, his mood swings are also highly contagious, which means that spending too much time in his company can make it nearly impossible not to fall under the spell of his current emotions. Now, in spite of his dangerously infectious bipolarity, however, Mr. Market also offers advantages to those who are properly forewarned and forearmed. First, he is so utterly narcissistic that he'll treat you the same regardless of whether you embrace him or ignore him. Either way, he'll pop back into your office as often or as seldom as you'd like. And second, he's perfectly content to either buy or sell any stock on the index at the going rate, no matter how overpriced or undervalued that stock may be. And again, He cares not a lick whether you're taking advantage of him or he's getting the best of you. Either way, he'll show up on demand and offer the same terms tomorrow, the next day, or whenever you're ready to see him again. Now let's take another quick break, and then we'll come back to wrap some of these things up. You might remember from our last post that Warren Buffett once observed, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." But one of the unmentioned keys to Mr. Buffett's success has also been learning to think more rationally and intelligently about Mr. Market and all of his often dysfunctional antics. So let's distill 3 key early lessons that one of the greatest investors of all time learned from both his own experiences and perhaps the greatest teacher of investments of all time. First, avoid speculating in stocks where the sole appeal is that they seem to be skyrocketing or have the potential to do so. Number 2, learn to think like the owner of a private business, which for Mr. Buffett came to mean buying stakes in growing, established, profitable companies, providing important goods and services in a manner that enable them to benefit from the compound growth over long periods of time. And even in these cases, be cognizant of what you are paying for a stake in the business. In other words, don't just jump in because the price is skyrocketing. And 3, avoid leverage, which can wipe out your ability to benefit from the recoveries that inevitably follow market declines. So this means avoiding buying stocks on margin or with any form of debt that's tied to the value of the stocks. Buffett also focused on owning businesses with little to no debt, so they can survive the economic downturns that they'll inevitably have to face. In essence, Ben Graham's teachings were designed to help avoid the potentially devastating consequences to the power of compounding that result from being lured into a bubbly stock market and then, after a crash, being scared away from an ensuing recovery. But obviously, it doesn't directly answer the original question of whether we're entering into a bubble, which is a topic we'll come back to in a future post. Today we face important challenges, but none that are greater than those we have overcome time and again throughout our storied history. Here's to hoping your day is as bright as America's future. I'm Todd Sheets, and thanks for your interest. Now, as a disclaimer, I want to say the preceding content is for informational purposes only, based on information available when it was created. It's not an offer or a solicitation, and it doesn't represent tax or legal advice. And it does not consider your financial circumstances and objectives and may not be suitable to you. All readers and listeners are encouraged to consult with a financial advisor who can consider your individual circumstances before making any investment decisions. If you found all of this helpful, please subscribe and recommend it to at least one other person. If you'd like to learn more and to find links to my free On Wealth and Progress newsletter and my book, please visit my website, toddsheetswriter.com. Thanks again.